why gold and silver sell off first as the most liquid commodities. It's disturbing emotionally when you see silver go down 10% in a day or gold go down 5, 6% in a day.
So silver's right now at 68, right? And it was at 75. So
That somebody up high is like laughing at my profession, and I'm like, I'm looking at him laughing at me, and I'm like laughing back at him, like, you have no idea, man.
it's just right now we got to go through the dollar crunch, and the dollar, like you said, the dollar liquidity is more important.
What happens if they just ignore gold and silver and go for a CBDC? So I'm like, Ivan, that's the same question as asking me basically, like, you walk to the top of the Burj Khalifa or some tall building, and then you walked off, and then gravity suddenly ceased to exist. What would happen? Dollar is more liquid. Gold is the next most liquid. Perhaps the minute that gold becomes more liquid, meaning the bid-ask spreads, gold becomes more of a liquid commodity than the dollar itself. That is gold backwardation. That is the end game. That is the end of the dollar. Like, why gold and silver sell off first as the most liquid commodities? It's disturbing emotionally when you see silver go down 10% in a day or gold go down 5, 6% in a day. I think I've seen a few times. And like, why are people selling gold? Isn't it obvious that that people need gold because inflation is getting worse? Yeah, that's true, but in the immediate sense of things, you need liquidity to pay your bills now, right? And as much as we don't want to admit it, or we don't like saying it, right now, dollars are more liquid than gold. So you need to use the second most liquid thing, which is gold, to buy the most liquid thing, which is dollars. That's just how it is right now.
Yeah, if you have debt obligate, if you're a company and you've got, AI stocks that are tanking right now, and you have, debts to pay because you're going to make payroll, and you've got a little bit of gold on your balance sheet, that's the first thing that's going to go. And so that's why. So gold and silver sell off first, but they don't sell off hardest. That's the way I'm trying to explain it to people. But yeah, when you're dealing, normies gonna normie, Rafi. So, when they say, "Oh, how's that gold doing, Phil? How's the gold and silver doing? Oh, it doesn't seem to be doing so well in this crash." So they're gonna do it until these people are gonna be wailing and gnashing teeth on the other side of this.
Oh man, I got to tell you.
Markets can panic long before the monetary system does, and that distinction destroys unprepared portfolios. According to Rafi Farber, sharp gold and silver sell-offs often reflect forced liquidity events rather than collapsing conviction. The overlooked pattern is that institutions sell what can be sold fastest, not what they value least. Retail interprets price action emotionally, while balance sheets operate mechanically. For wealth preservation, confusing liquidity demand with failed thesis can become the most expensive mistake of the cycle. Next, Rafi Farber exposes why temporary dollar strength may be the exact signal metal investors misunderstand.
So again, I just got back from the hospital, minor procedure for a family member. Everything's fine. Um, and the trying to explain what I did for a living, because he's bedside manner. He's asking us what we do for a living. So I try to explain what I do, and I explain why gold and silver are money, and the shekel isn't. He's like, "What do you mean? Of course the shekel's money. Aren't you paying me in shekels?" And I'm like, face palm, and he starts laughing at me. That's what you do for a living? He's laughing at me, like this is like a surgeon. He's high up there on the economic food chain. I'm like, normally this should like bash my ego that somebody up high is like laughing at my profession, and I'm like, I'm looking at him laughing at me, and I'm like laughing back at him, like, you have no idea, man. So we're just there like laughing at each other, and it's like you don't it's okay, like, you're not hitting my you think you're hitting my ego now, but you're really not. You just look like a fool. But okay, but I trust you with the procedure. Go do your thing that you were trained to do, and then, get the next patient, do the same thing to that one, and that's it. It's fine.
Yeah. Yeah, exactly. The day-to-day transactions do not defy any of the laws of economics, of Austrian school economic. Like, I'm not sitting there like, "Oh, geez, am I wrong? Did the law is Rothbard wrong? Is the demand for silver not, the monetary demand for silver not there?" No, it's there.
Nobody questions fiat during convenience cycles, but confidence becomes visible only when it breaks. What Rafi Farber is highlighting is the difference between transactional currency and stored purchasing power over long periods. The contradiction is that most people trust systems they never stress test. Markets reward specialization, but monetary shifts punish blind trust in consensus assumptions. Savers rarely notice the distinction until inflation and asset repricing force the conversation into everyday life. Next, Rafi Farber unravels why widespread belief in currency stability depends on ignoring one uncomfortable historical pattern.
It's just right now we got to go through the dollar crunch, and the dollar, like you said, the dollar liquidity is more important.
I think the way I put it with Ivan in my last stint on Wall Street Bullion, I think it's called now,
Yeah.
whatever he calls his channel now. So he asked me the CBDC question, like what happens if they just ignore gold and silver and go for a CBDC? So I'm like, Ivan, that's the same question as asking me basically like, okay, well, let's imagine you walk to the top of the Burj Khalifa or some tall building or something, and then you walked off, and then gravity suddenly ceased to exist. Like, what would happen? So I said, well, I mean, if that's the question, you'd float and everything would be fine. But is that going to happen? No, it's not going to happen. You're going to fall.
Yeah.
Okay. So that's the answer is that's not going to happen. The other idea that I just got in my head, I'll throw it off you, and I don't know if you'll be able to volley, but how about this? Dollar is more liquid. Gold is the next most liquid. Perhaps the minute that gold becomes more liquid, meaning the bid ask spreads, gold becomes more of a liquid commodity than the dollar itself. That is gold backwardation. That is the end game. That is the end of the dollar.
Yes.
Okay.
Yeah,
And
probably.
yeah, and what is the
No, I
mechanism
don't know. Is it?
what's
It's not liquidity. It's not like the dollar becomes less liquid because nobody.
Well, it's impossible to define it that way because the
Yeah.
liquidity of gold is defined by the bid-ask spreads as measured by dollars, right?
Right, right, right.
That's the
So
liquidity of it. So
it's
so
not
it's
that the
hard.
dollar became less liquid. It's just that the dollar law. There's no more debt in a hyperinflation. No,
This same liquidity debate appears near turning points far more often than financial media admits. Rafi Farber's argument suggests the real battle is not gold versus digital money, but liquidity versus trust. Timing matters because policy narratives usually change only after market behavior forces them to. Investors who focus only on headlines miss the sequence institutions watch first: funding pressure, spreads, then confidence. By the time public messaging shifts, capital has already repositioned. Next, Rafi Farber reveals the hidden threshold, where liquidity stress becomes a confidence crisis.
more debt obligations. So like nobody wants the dollar anymore. But
Okay,
yeah,
so I guess that's the better way of putting it, because we're
yeah,
we're, de we're dealing with it with definitions that fold in on themselves here and create the monetary black hole that we're all trying to
yeah. It
predict,
is an
avoid,
Ouroboros.
whatever, right?
Yeah.
So the the liquidity. Okay, I had this idea in my head. Okay. So the mechanisms of how this would go down is that, yeah, if debt obligations just cease to exist either by the Fed buying all the debt, right? Let's say if the Fed bought all debt of everything in the entire planet right now,
Might happen.
then nobody has any debt obligations, then nobody needs any dollars, and the bid for the dollar would go to the floor, right? It would go to
Right.
zero. But
Exactly.
the other way that it could happen is that you start having a deflationary crash, and then you got margin call by margin call by margin call domino, and the Fed does nothing, and then everybody defaults on their debt obligations, and then nobody has any debt obligations after that anyway. And then the dollar falls to the floor through that path. It's the deflationary or hyperdeflationary, hyperinflationary path, but it's all the same because it all leads to gold in the end.
Yeah. Exactly right. Now, I will say if for it won't happen, they will print, but like if they didn't, the dollar would just be so valuable during that deflationary panic. If they actually didn't print, that'd be kind of wild.
Yeah, it's not going to happen.
Yeah, they'll print.
The most dangerous assumption in markets is believing policymakers will tolerate uncontrolled deleveraging. This is where Rafi Farber's thesis shifts from metal prices to system preservation. Central banks publicly defend stability, yet history shows intervention usually accelerates once debt markets tighten. The contradiction is that every rescue mechanism eventually changes asset incentives somewhere else. For investors, the risk is not missing a rally, but misunderstanding what policies are designed to protect. Next, Rafi Farber exposes the quiet trade-off between preserving credit markets and preserving purchasing power.
So let me ask you this, but we'll wind down now. Michael Oliver's calling for $300 to $500 silver by end of summer. You think we could hit that?
I don't know. I have a feeling not, because I always want to be conservative.
Yeah, I do.
But I have a feeling that when it happens, it's going to surprise even me.
Yeah.
And you know how you look back, and your kid is grown up, and you're like, it went so fast, but it went so slow. So that's good. Whenever this hits, it's going to be the same emotion. Like it came so fast. I wasn't expecting to be so fast, but then again, we've waited maybe 20 years for it, or however long it's going to be. I still hold hard and fast to my theory that there's just going to be one more banking crisis, not two. The only question is, when does that hit? And once that hits, then I think we're weeks to months out.
I think the fact that they had to reduce the Wells Fargo's or the banking regulations, the liquidity, the extra liquidity you found, that makes me think something's going on.
Mhm. Well,
Like they had to
they
get
didn't have to. I think they planned it. They planned it in advance, and those rules actually. I don't know exactly what the rules were, but they went out the window on April 1st, 2026, and that is exactly when the AI bubble started to just go vertical.
Yeah, but
And
if
also
they
South
hadn't done
Korea.
that, then Wells Fargo couldn't have gotten the loans out fast enough, and then they would have run into a banking crisis. So they did it because they're running into a wall.
Yeah.
So we'll see.
So one question for you, as the husband of a South Korean woman, um,
Big market moves rarely feel explosive while they are forming. They feel delayed until suddenly they are not. Rafi Farber notes that extreme silver targets matter less than understanding what conditions could produce them. Regulatory easing and liquidity expansion often appear as technical adjustments until asset prices react disproportionately. The question investors miss is not whether forecasts are too high, but whether system responses are becoming more aggressive. Wealth protection starts with watching incentives, not predictions. Next, Rafi Farber reveals why institutional liquidity decisions may matter more than silver price targets themselves.
what do you have any inside information as to what is going on in South Korea? Why is the
I mean,
stock market going so nuts?
it's two companies. It's Samsung and some random chip company that just that's it. It's two companies that are
That's
just
it.
going completely vertical. It's a breath of two. It's
Maybe
those two
maybe maybe
companies
we maybe we can short them.
like yeah. You might want to consider that, to be honest, but you never know. I mean, you never know how long the party can last. But yeah, those two, every other company is either going down or sideways, and those two are just going absolutely vertical, and
But
that's lifting up the entire Kospi.
yeah, but before we sign off, I just want to show the South Korean chart here. It's just mind-boggling. That's South
Yep,
Korea. It's
that's looking
crazy.
pretty in-gamey.
It's really nuts.
Yeah, and when the wand blows, it's gonna really be gonna be grim.
So do you think the end game is going to happen before South Korea just dies from not having people in it?
Yes, yeah. Yeah. I think
Yeah.
the end game's like any day, any day. I always wonder, like every time we do a bidder in game draft, I'm like, is this going to be the last one? I don't know. We've talked about that before.
Yeah.
What do you think? Is this going to be the last bidder in game draft? Do you think we get another one?
I don't know. I want to stop looking like an idiot and predicting.
Markets went up, but participation narrowed, and historically that's where confidence starts lying to investors. As Rafi Farber points out here, when a market advance is carried by only a handful of names, price can become a headline rather than a signal. Institutions often celebrate index strength while ignoring deteriorating breadth underneath. The real question is whether capital is chasing productivity or simply escaping weak growth elsewhere. Concentration feels safe until liquidity suddenly becomes selective. Next, Rafi Farber reveals why narrow leadership often appears just before the public narrative changes. The system calls it stability.
Why gold and silver sell off first as the most liquid commodities. And 3, all scams prey upon a vulnerability of the victim of the scam. In the case of the dollar, it was pride. And we'll have Phil expand on those and I will respond. But the first thing we're going to talk about is actually what happened on Friday, because it looked pretty crunchy to me. Though these things have happened before, it could reverse tomorrow and just go back up. We don't know. But it looked pretty severe. So, Phil, do you think that the end of the world is nigh, and do you have enough hot sauce to deal with it?
Hot sauce?
The hardcore pornographic sauce. But I don't think that's what they meant by it.
I'm a big hot sauce fan, so I'll have to look into them. And I do have a lot of hot sauces for the end. I actually literally did stack up extra hot sauces for the end game.
Okay.
So the question is the end game nigh? Quite possibly. Things are getting
No, I mean
really,
the crunch. The crunch, I mean.
Yeah, the crunch does look like it's getting very nigh. Like this could be it. But like we don't know, because we don't know how much is sloshing around. Now you found where the extra liquidity. I was like, how is everything going vertical right now? And you found the extra liquidity. They basically got rid of all the banking regulations they put in after '08, so that huge banks like Wells Fargo could get extra liquidity out there, and people could jack up, borrow money from Wells Fargo to like jack up into the stock market. So
Yeah.
that's where it was coming from. However, because of the law of exponential growth, they now have to find exponentially more dollars to put into this to keep this thing going.
Yet every cycle seems to require more liquidity than the last one. Rafi Farber notes that exponential credit expansion creates a hidden dependency most investors never price in. Media coverage focuses on price gains while ignoring what those gains cost in leverage and policy flexibility. The contradiction appears when officials celebrate resilience but quietly relax guardrails to sustain momentum. Savers pay the price later through distorted valuations and reduced purchasing power. Next, Rafi Farber exposes the institutional trade nobody admits is supporting asset prices.
And eventually people are just going to abandon it and rush everything into consumer goods, which they're already starting to do now. But the question is, so I got emailed from several viewers who've emailed me saying, Phil, I've been stacking for a while, but bad things have happened to me and my liquidity is drying up. Should I sell my metals now to pay the liquidity, to come up with the dollars I need to satisfy my debt obligations? I would say absolutely not, to the extent you can avoid it. And so we're not allowed to give advice. That would be illegal. But I will say what I would do, and if I was myself right now, so I have a very large cash reserve because I knew this was coming. And I warned people, I said, make sure you keep a large cash reserve for the deflationary aspects of it. You don't just zero out your accounts going into silver thinking silver's going to go to $300, $400, $500, because it will go there. But as you can see right now, silver's at what, 62, 63?
Mm-hmm. Yeah,
so
something like
is it
that.
62, 63? Maybe it's 68, 69. It's under 70 right now. So you don't want to be caught in the deflationary crunch. You don't want to be caught with your pants down, having to sell your metals at a localized low rather than at a very high level, right?
68.
68.
And this Chateau LeBlanc 68 is supposed to be served slightly chilled. This ain't room temperature. What do you think we are? Animals?
Okay, so silver's right now at 68, right? And it was at 75. So
liquidity dries up for even 90 days, portfolio decisions become survival decisions. What Rafi Farber is highlighting is that asset conviction means little without cash flow endurance. Investors often underestimate sequence risk, the need to survive volatility long enough for a thesis to play out. Wall Street sells upside scenarios, but rarely discusses forced selling pressure during drawdowns. Protecting wealth is less about maximizing returns and more about avoiding irreversible exits. Next, Rafi Farber reveals the one mistake that turns temporary market stress into permanent capital loss.
People, the stackers right now are hurting along with the Bitcoin bros, right? We're hurting almost just as much. if you put all your money into silver at 120 and you put all your money into Bitcoin at 125, we're about equally as bad off. You have to hold faith that the silver is going to rebound and Bitcoin is not going to rebound. And it's not necessarily a matter of faith. It's just a matter of logical understanding of the situation. It will be okay. Anyway, some advice for some people that I've been trying to think of. If you are worried that you need liquidity, if you're sitting there like emailing me, not if you're a normal person or not if you've already stacked a bunch of dollars. If you haven't stacked dollars for the deflationary crunch and you need dollars and you're sitting there, what can I do? I would immediately begin stacking some dollars. I would even stop stacking metals because you need to make sure you have enough dollars for the big crunch when it hits. So I would stop contributing. Sorry, I'm not allowed to say you. So I would stop contributing to my 401k. I would stop contributing to any other employment stuff to maximize my paycheck, and I would cut back on expenses as much as possible to make sure that my paycheck was getting, because prices are going up really, really fast right now. So I would make sure that I, cut all the extra expenses that you possibly can to make sure you lost your camera again, to make sure that your expenses are as big as possible. Oh, sorry, not your expenses. Your income is as large as possible.
This happened before previous liquidity squeezes. Strong narratives collapsed because investors ran out of time, not conviction. Rafi Farber's argument suggests that portfolio structure matters more than asset ideology during stress cycles. Markets punish concentration long before they reward patience. The overlooked contradiction is that people prepare emotionally for inflation, but operationally get hit by cash shortages. The goal is not predicting the turn. It is staying solvent long enough to benefit from it. Next, Rafi Farber walks through the exact sequence institutions follow before liquidity conditions reverse.
Minus the expenses of the ever-increasing food supplies or food prices, so that you can get through weather this inflationary storm and have cash left over for the deflationary crunch. And I'm sorry, that came off as a little bit word salady there. If you are in a dire strait, like let's say people are starting to lose their jobs right now because of the deflationary crunch, the beginnings of it. If you are finding yourself in a situation of underemployment or unemployment, and you still have stacks, but you don't want to liquidate them, and I would advise not to liquidate right now. You got to hold those stacks through. And this is the hard part because we're about to, as we will discuss in the next segment, gold and silver are the most liquid commodities on Earth. So they are the easiest things to sell for quick cash. So it's really hard to sit there in a deflationary crunch and not sell the easiest thing in the world to sell to get quick cash. But if you want to maximize your gains through the end game, you have to get through that deflationary crunch part and not sell your stacks at this time.
Mm-hmm. Okay.
The assets investors trust most often become the first assets they sell under pressure. This is where Rafi Farber's thesis shifts from price targets to behavioral stress testing. Liquidity events expose whether ownership was strategic or simply emotional comfort dressed up as conviction. Institutions maintain reserves because they understand timing risk. Retail often remains fully exposed until forced to react. The biggest losses usually happen when investors abandon long-term plans for short-term relief.